Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending July 8th, 2022. Appreciate you all tuning in to this channel and subscribing to this channel as well as our podcast, InvestTalk. Now, this week I'm going to title the video Relief Rally Continues as Economy Slows. And everyone was focused on the jobs number this week, which I'll get to in a minute, but most importantly were the PMI figures. We had slowing PMI figures last week on the manufacturing side, and this week we had the services PMI. Remember, this is a purchasing managers index, and the overall index decelerated a bit from 55.9 to 55.3, so that showed a bit of slowing in the month of June. And then what was most important though were prices paid. That came down second month in a row from 84.6 to 82.1, now to 80.1. So still elevated, but you can see inflation has likely peaked. You have employment index that also dropped to a shrinkage. April, you had a little bit. Remember, anything below 50 is shrinking part of this series, and clearly the employment market is starting to show the effects of higher rates and the slowing economy, and this is a big part of what I'm going to talk about in a minute, which is the Fed eventually pivoting sometime this quarter. Initial unemployment claims for the week of July 2nd, that also ticked back up. We were kind of consolidating here at 230-ish level, now to 235, the highest level since January. Now the actual non-farm payrolls number came in a bit better than expected. It was expected to be a drop more into the 200s from 384 in the month of May, but we only dropped to 372. Now the ADP figure on Wednesday was even worse than this, so could see some revisions next month. But overall, it was a relatively strong, stronger than expected, let's say that. Definitely a deceleration, but a very modest deceleration. But the Fed wants this, right? The Fed is happy to see the job market decelerate a bit because of this. Average hourly earnings. And if you go back, let's go 3 years, you can see this above average acceleration basically since the pandemic. Pre-pandemic, we were about 3%. And then it ticked up all the way into the fours. You had a bit of a dip here in April of last year, but now still kind of trending in that 5 range, which is once again much higher than the 3 range that we were in pre-pandemic. So the Fed wants to see this come back in, and that was some progress in the month of June. So that was the major economic data to pay attention to so far this week. But I want to pivot over to the charts, NYSE. And this continues this week. We had 4 trading days. Remember, 4th of July was on Monday. And it was basically a flat week overall. Here's where we closed on last Friday, and we closed modestly, very tiny bit higher this week on equities broadly, the NYSE. The S&P though, let's pull up the S&P. This hit the top end of kind of resistance. Remember, we had this little breakdown candle. We reversed it. We'll see if we can close above it. That would be a nice sign that we will go probably to the next level. And if we get there, here's the 50-day on the red line. But I think we get all the way down to this breakdown level right around 4,100 on the S&P. So that'd be 200 points. That's 4 or 5% from here. So I think that's certainly possible as we just go through this kind of consolidation, near-term bullish consolidation period. And I think this is all starting to price in a bit of a relief rally. And you saw that with the pricing in a Fed pivot that brings a relief rally. And you saw that more in the NASDAQ. NASDAQ closed right at the top of that. Let's see, did we close? Let's see. The high of that candle would be 11,635, and we closed today at 11,635, right on the nose. What was pennies? 11,3. 85, and we closed at 31. Okay, so pennies away from breaking the top of that red bar, and right into that 50-day moving average. So you see the MACD. Look at this MACD divergence. This was telling you that this breakdown here was false. You had MACD diverging higher. And I still continue to believe that we're probably in this near-term relief rally. Maybe for the next few weeks, maybe the next few months, we will see. But there's some strong indications of this. Not just that you're getting growth outperform value, which typically we'll show you in a minute. Rates were up this week, and that typically means bad things for growth stocks. Well, this is IWF to IWV, so this is going up. That means growth's outperforming. All 4 days this week, growth had a nice rebound compared to value. Still in that downtrend, but definitely a relief rally in a lot of the beaten down tech and growth names. You also got a relief rally in housing. Look at ITB. It's just very strong. Once again, MACD divergence on this breakdown and getting a relief rally. So you're getting a rally in rate sensitive sectors, despite rates not dropping very much. So that's a near-term indication that the market is pricing in a very different Fed policy stance. And here's the 10-year. Down on Tuesday, but Wednesday, Thursday, Friday, all up, powering back up to about 3.1 in the 10-year, which once again typically is headwind for equity for rate-sensitive equities, but not this week. And I think that's telling. I also want to look at the currency market. This is also telling. So here's the UP, and you say the dollar. This is dollar strong. Well, it's strong against the euro. Here's the FXE, and remember the euro is the biggest weighting in the currency indices, and the euro is, I think, weak mainly because of economic weakness there. Higher energy prices, a lot of recessions, Germany going into definitely a recession with shutting down factories because the cost of their energy is way too high, etc. So the European economy is definitely the weakest of all. You think we're weakening? Yes, we're weakening, but we're strong, especially in relation to Europe. Now, the FXY, the yen, we had the unfortunate events of Shinzo Abe being assassinated. Was that yesterday? Yeah. So, hearts go out to the Japanese, but when it comes to the yen actually held up well. Despite the dollar strengthening, you would think the yen would continue to break down with them continuing with their yield curve control and their 25 basis point rate on their version of the Fed funds rate. But it's not breaking down. And I think this is an indication that the Fed is going to be starting to migrate closer to what the Japanese are doing with their Fed policy or with their policy. So I'm interested to see when that turns. You're getting that MACD divergence here. Look at this. So something I'm definitely watching. Now the commodity markets, DBC, got a nice little rebound over the last couple of days, but certainly lower on the week. You had energy. Here's the USO, kind of the same pattern there. It's certainly the biggest weight within that particular sector. Gold broke down, but you're also not getting a huge breakdown in the MACD. I'm looking at the GVZ. This is the gold volatility index. Typically, this should be breaking out if gold's going to go into some free fall. But I'm not seeing it. Like, look at this breakout here in February, and then mirror that with the move in the gold price. I'm not seeing that breakdown. So definitely back into neutral stance longer term, and something that I'm watching for a potential reversal. High volume this week, and I'm looking at that volatility index. And then let's look at the JNK to the IEF. So this is yield spreads, and this was interesting as well, is that you had a nice reversal over the last 4 days, showing the Fed is likely to pivot. And then SHY, I'll dig into that quickly. So this is short-term rates, obviously, and look how this is setting up. MACD divergence. You continue to, this is trying to break down, but it's just not able to. You had a little bit of drop in rates, increase in rates over the last few days, but overall, this is starting to look like more of a reversal pattern than a continuation lower. So that's something I'm looking for. And then Bullard had a comment over the weekend, or the week, I think it was yesterday, day before, about how the Fed could return to cutting rates once inflation is under control. Now, what does under control mean? What level is that they feel comfortable with? We'll see. But I think it's the start of rhetoric that shows the Fed is closer to capitulating on their rate policy path, and that's really what it's about. It's not that they're going back to QE anytime soon, or soon in the next few months or a couple of quarters, but it's, hey, maybe they don't raise 50 basis points in September. Maybe they only raise 25. Maybe they pause for the fourth quarter, et cetera. And I think that's going to be how things evolve as we continue to see weakening economic data throughout the summer. It's kind of weird, which we've seen that for the last decade plus, which is weakened economic data is actually good for the markets because it means less pressure on rates going up, and that buoys asset prices. So that's where we're at this week. Very interesting week, and see what kind of follow through we get both directions next week. A reminder that the contents of this video are for educational purposes only. It should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. I appreciate you all tuning in, and you have a wonderful weekend.